versus active investing. Our moderator today is Ken Fincher, Senior Vice President and Portfolio Manager at First Trust Advisors. Mr. Fincher joined First Trust Advisors in November of 2008 after spending the previous 3 years at Calamos Investments and 17 years at Nuveen Investments. His current responsibilities at First Trust include management of separately managed accounts that invest primarily in closed-end funds. Previously, his responsibilities at First Trust included the development of new product structures in the closed-end fund space. At Calamos, Mr. Fincher served as product manager and client advocate for the Calamos closed-end and open-end mutual funds. In this role, he worked closely with strategic alliance partners, as well as intermediate distribution, portfolio attribution, CRM, and marketing teams. While at Nuveen, he spearheaded the development of the dividend advantage structure that enabled Nuveen to raise significant new closed-end fund assets, as well as development of the first public disseminated closed-end fund index and the website etfconnect.com. Mr. Fincher has been named Outstanding Individual Contributor to the closed-end fund sectors in 2004, 5, 6, and 7 by Financial Analysts and its peers in the closed-end fund community. Ken will introduce our next panelist in a moment. I just want to remind everybody that this webinar does qualify for 1 CFP credit. So if you're looking for CFP credit, please email us after the webinar and we'll be happy to set that up for you. So Ken, I'll pass this on to you to introduce our panelists.
Thanks, Patricia, and good afternoon, everybody. We have, as Patricia mentioned, this is passive versus active investing, and we have 2 panelists today that will talk about both sides of this type of investing. Our first panelist is Rick Ferry. Rick is the author of 6 investment books and is a leading expert in low-cost index fund investing. Rick utilizes his in-depth research about index investing strategies to direct the investment committee he heads at Portfolio Solutions. It's a low-cost investment management firm he founded in 1999. In addition, Rick shares his insight as a frequent news commentator, Forbes columnist, media contributor, and public speaker. A CFA charter holder through the CFA Institute, Rick holds a Master's of Science degree in Finance from Michigan's Walsh College and has served as an adjunct professor. He earned his Bachelor of Science degree in Business Administration from the University of Rhode Island. Prior to entering the financial industry, Rick served as a Marine Corps officer and fighter pilot before retiring from the reserves in 2001 with 20 years of service. Our second panelist is Daniel Spears. Dan has worked in the investment management and investment banking, focused on the natural resource sector since 1995. He joined Swank Capital in 2006 and has 2006. He is an investment banker, and prior to that, he was an investment banker at the Natural Resources Group at Bank of America Securities, and has worked in the Global Energy and Power Investment Banking Group at Salomon Smith Barney. Mr. Spears earned his BS in economics from the Wharton School at the University of Pennsylvania. He currently serves as the board of directors for Central Energy Partners, LP, and Emerald Oil, INC. Without further ado, we're going to turn this call over to Rick, and Rick's going to give us sort of the side of the passive manager and why passive investing makes sense. And following his comments, Dan will give us an overview of active investing and where active investing makes sense in the markets today. So, Rick?
Thank you, Ken. I appreciate the opportunity to talk about this. You know, I wasn't always an advocate for low-cost passive index investing. I spent my first 10 years on the active side, and I think seeing the results of that caused me to become an index fund advocate. But I wanted to talk today about what is passive investing so we can get the conversation flowing in the right direction with some sort of a terminology, understanding of what passive is versus what active is. So I'll talk first about the 2 axes of active investing, and that is either security selection or asset class timing. So basically, asset allocation and security selection. Let's start with asset allocation first, and that is whether you believe that you can find value in asset classes on a top-down way, where you feel as though the equity market is overvalued or undervalued, or the bond market is overvalued or undervalued, and you're going to do a tactical asset allocation of your asset classes. That would be an active strategy. Or you're going to be passive about your asset allocation, meaning you're going to set it and forget it. You're going to pick perhaps a 60% stock, 40% bond allocation for a client, and when the portfolio is off of that mix by a certain percentage, or maybe once a year, you're going to rebalance back to the 60-40 mix, and you're going to keep this strategic fixed allocation for a client until something changes with the client. On the security selection side, we're looking at active and passive, meaning you're trying to select investments or weight investments in a portfolio to outperform a market benchmark such as the S&P 500 or the Wilshire 5000, or a bond index such as the Barclays Capital Aggregate Bond Market Index. So you're trying to select individual investments that are going to outperform that benchmark either nominally or on a risk-adjusted basis, or you're just buying the benchmark. You're buying an index fund or an exchange-traded fund that has very low costs, that literally just mirror the asset allocation, mirror the actual security selections in the benchmark itself, and you're going to get the return of the benchmark in your individual securities. So those are really the two axes, if you will: asset allocation, active versus passive, and individual security selection, active versus passive. And together, these things go together to form portfolio management. And so if you want a true passive portfolio, you're going to do a strategic fixed allocation, set it, forget it, and rebalance. And you're going to do indexing as a strategy to capture the returns of the markets rather than trying to pick individual securities that are going to outperform the markets. All other strategies are really an active strategy, even though we have a lot of strategists now that are picking passive index funds that are tracking markets, but they're doing it in a tactical asset allocation. That would be an active strategy. So specifically on index fund investing, which is buying funds that are trying to track the markets as opposed to outperform the markets, up until 2000, there was individual studies that were done on a one-off basis that looked at the performance of actively managed mutual funds versus index funds. And these were big mammoth studies. There was nothing that was done on an ongoing basis. Today, though, we have several different companies, S&P, Vanguard, Morningstar, that on an annual basis are tracking very closely the performance of actively managed funds versus index funds. In addition, it's now widely known that the traditional mutual fund databases that house the performance of mutual funds were severely lacking in that they didn't include a lot of the funds that had closed or merged during a period of time. So if we're looking back 10 years and you were trying to see how many active managers outperformed over a 10-year period of time, the old databases or the incomplete databases didn't have all the funds in it because it didn't include the funds that were closed or merged. Well, now most of the studies that are being done are using a survivorship bias free database from the University of Chicago, which has all of the funds in it, and it's an all-inclusive database, a full database. So now we can actually look at how many fund managers actually outperformed the index funds in each one of these different asset classes and styles, and include in that the funds that closed or merged with other funds, which typically close or merge because their performance has been very poor prior to them closing or merging. The record on active management versus indexing is not good. And it doesn't matter how far back you go. You can go all the way back to the 1930s, and you could find studies by Alfred Cowles, where he calculated the performance of active management and compared it to the performance of the Dow Jones Industrial Average. And we find that, on average, the active managers about 2/3 of them that are surviving tend to underperform the benchmark they're trying to outperform. And that 2/3 of the surviving managers underperforming versus 1/3 outperforming is fairly consistent through the next almost 100 years. There have been studies in the 1940s, studies in the 1950s, studies in the 1960s, particularly William Sharp and Gene Fama and other people who are well-known names today who did studies on active versus passive during the 1960s, and very comprehensive studies, and found that of the surviving managers, about 1/3 outperformed and 2/3 underperformed. They didn't include survivorship bias in that. If you do include survivorship bias, if you were to go back and redo those studies with a survivorship bias-free database, you find that it's more like 75% of the active managers underperformed. So this is a long history of underperformance. You can get on to the Vanguard website and read a paper called The Case for Index Fund Investing. You can look at Morningstar data that comes out. Standard & Poor's comes out with the SPIVA report that shows on every 6 months the percentage of active managers that are underperforming, and basically literally every category across the board, both stocks and bonds, both in the U.S. and international. It comes out to about that 80% number when you look at the when you include the survivorship bias. When you take out survivorship bias, it comes out to about that 75 to 80% number of underperforming. Bond managers underperform more because it's much more difficult, I think, to outperform the bond market given the nature of bonds versus stocks. That said, I did a study a couple of years ago that looked at if you were to put a portfolio together of all index funds versus a portfolio of all actively managed funds, what's the probability that an all index fund portfolio would outperform a portfolio of all actively managed funds? And I used the CRSP survivorship bias-free database there as well. And here again, the probability of a portfolio of all index funds outperforming portfolios of all actively managed funds goes up even higher than that 75% or 80% number. You get up into the 90, 92, 93% probability once you start adding multiple asset classes using all index funds as opposed to multiple asset classes using all active funds. The other side of the coin on this is looking at the managers that do outperform. How much do they outperform by versus the managers that underperform? How much do they underperform by? And here we have another problem in that if you're going after trying to pick active managers that outperform, even if you do pick one that outperforms, the outperformance on average is only about 1/3 of the average underperformance of the majority of managers that underperform. U.S. equities, for example, on average, the average manager underperforms by about 1.5%, but on the minority or the small probability of managers that outperform, they only outperform on an average of about 0.5%. So you have a very low probability of finding managers that are going to outperform, and then even if you do, you don't get paid for the risks that you're taking, or you're not getting paid enough. If those active managers were averaging 2 or 3 percentage points or more above the market, then I would say, sure, it makes sense to take that risk, even though there's a low probability of finding active managers. It would make sense to take that risk because they outperform by so much, but they don't. And so it's a difficult thing to do, to go out and try to find active managers who are going to outperform the market in the future. You could look at different matrices like past performance. That doesn't work. There's very little persistence. You could look at where the managers went to school. That might help a little bit. You could look at how much money is in a fund. That could possibly help. But the bottom line is extremely difficult to find active managers that are going to outperform in the future. The odds are against you, and even when you win, you don't win by nearly enough to make up for the risks that you take. That's why I'm a proponent of passive investing. And that's my spiel.
Thanks, Rick. Dan, if you want to give the other side of the coin, and then we will work towards getting this open up to questions from the audience today.
Sure. Again, I'm Dan Spears from Pitching Asset Management, and a lot of people probably don't know about our firm. We focus on energy infrastructure and energy renaissance strategies, managing about $4.5 billion on the active side, and we also have indices where we have about $1.5 billion index-linked products. And so, I think there are roles both for active and passive. I think from my other panelists here is, we believe that both active and passive strategies can be utilized to optimize a client's portfolio. I think that when you look at things like large, broad-based market indices like the S&P 500 or some of the larger Russells, they are tough to beat. And so a lot of his data is probably accurate because that's what most people focus on, is all the managers chasing to try to beat the S&P 500. The problem I have with some of the passive strategies is, market cap weighted indices have numerous structural issues, we believe, because effectively you continue to buy the bigger guys as they go up and you're selling the smaller guys. And you can have instances where companies like Apple are effectively 5% of the S&P 500. So you have to ask yourself whether or not, and look at the construction of the index, whether or not it is really a good measure of the sector as a whole. And that's why we think the broad-based indices, they minimize out-of-favor sectors. And I think that's where active managers can really create alpha. Successful active managers can add alpha, especially, I think this is especially true in sector-specific indices. And very, narrow indices that we focus on, say, like master limited partnerships or the emerging industrial manufacturing renaissance. There's not a lot of indices that track those. So for an active manager to go in there and find these companies, by traditional fundamental due diligence and analysis, I think that active managers can create alpha. It is really focusing on sectors that aren't broadly owned and sectors that may be out of favor, but you could have a situation in where the underlying dynamics are improving and should improve over the next couple of years. The other thing to look at it is, every client has individual needs, and each client has its own risk management concerns. And so there could be a use for an active manager that takes those into account to help the client that, they don't need exposure to a passive index. They really want some active management because they want to be more aggressive, and they understand that they could potentially outperform in the upside and potentially downperform in the downside. It really is up to the client and the FA to understand what the client's needs are and what their risk tolerance is, and when developing an allocation model so that they do have exposure to some out-of-favor sectors or sectors that aren't broadly owned. The other thing with passive indices is, there's some thinly traded stocks out there, and if they happen to be in an indice, then you can have an unintended impact when you've got forced buying or selling, and you can see a lot of that happening in large, exchange-traded products. When a company is added or deleted from an indice, there's abnormal trading in that stock. So there's, I think, a lot of ways to create alpha on the active management side, and it's really a measure of sector allocation and what you're focused on and what the client is focused on. So when you're looking, I think the long-term studies that you're talking about maybe not take into account exposure changes in allocation and changes in the economy in which you would want to move your portfolio maybe to an active manager who can wade through a certain situation better than a passive indice. And so that's why I think that there is still a role for active managers. I think it's a much stronger and a better role on, well-defined niche strategies where active managers can continue to produce alpha. Thank you.
Thanks, Dan. Just a reminder to the audience, we will open this up for questions. But I had a question right out of the box, and Rick, and help me a little bit here. Obviously, with the advent of the ETF space over the last, let's call it 15 to 20 years, we've seen an explosion in the number of indexes that are created. As an investor, how do you identify effective, similar to what you would have to do in an active managed strategy, how do you identify indexes that actually make sense in today's market, given that the explosion of indexes with the ETF space?
Well, that's a great question, because there's really two different types of indexes now out there, whereas up until about 12 years ago, there was only one type of index. And the one type of index that existed up until 12 years ago was a traditional cap-weighted index that was a benchmark for measuring the return of a market, or perhaps a segment or sector of the market. And these indexes were used not only for investment purposes. In fact, that was the last thing they were used for. They were used for economic purposes. They were used for determining asset allocation in portfolios. So traditional market benchmarks were used for many things, and only because they started to be used for performance comparison, to measure the performance of active managers against these benchmarks, did people begin to realize in the 1960s that active management wasn't outperforming. Now that was pre-2003. You had those, and there were a lot of those indexes out there, but they were your typical companies such as Standard & Poor's, S&P 500, 400, 600. There was Russell, Wilshire, MSCI, and FTSE, and so forth. So they were the typical old line, if you will, index providers. What happened in 2003 was a company filed with the Securities and Exchange Commission to launch a non-traditional index. It was called an Intellidex index, and this thing was a quantitatively derived strategy, investment strategy, that chose 100 stocks for their investment value only to be held short term, where this index would be rebalanced every quarter. And it wasn't an index. It was an active management strategy that had been mechanized down to this quantitative methodology. And but in order to launch an exchange-traded fund, the Securities and Exchange Commission said back in 2003 that if you want to launch an ETF, you have to follow an index. And so somebody created, Bruce Bonds, who was at Nuveen at the time, but became founded PowerShares, worked with the MX to create Intellidex indexes, which are quantitatively derived portfolio strategy methodology that they called an index. And then they went to the SEC and they said, well, here's our index, and this is how we do it. It's transparent. It's based on a set of rules. Can't change the rules. Here's what we come up with. We come up with a list of stocks, and every day we're going to publish that list of stocks. And this is all the characteristics of an index. And the Securities and Exchange Commission agreed with them, and they were able to launch an ETF based on this index. Well, that just opened the floodgates. Every active management strategy that you can imagine all of a sudden became an index. So now active management is indexing. And even though these things are what we call strategy indexes as opposed to benchmark indexes, the whole world now is an index. I mean, you have your left foot index, your right foot index, your CEO above 5'10" index, CEO below 5'10". I mean, you name it, everything's an index. And it's made it extremely confusing. However, you can divide the world up between benchmark type cap-weighted indexing, the traditional stuff, and you can very easily see what's a strategy, what's an active strategy that has been put into an index form for the purpose of marketing. And I say that you should create a portfolio first, a core portfolio, out of those traditional, very low-cost benchmark type index products. The other stuff, the strategy indexes, I guarantee you that they're much higher cost, 10 times, 20 times higher cost, they're ETFs that follow those index strategies, and there's much higher turnover of a traditional market index. So it is confusing, and I agree, and I think that the SEC didn't do anyone any favors by allowing this thing to be called an index. They should have allowed it to be called something else, but to call it an index just created a whole bunch of confusion. But you can really look at the market and say, yeah, there are the traditional benchmarks, and that's where you should begin. And all this other stuff is just active management that has been repackaged into something called a strategy index. It's been called a lot of other things too. You heard the term smart beta, which is a terrible term being thrown around, but those things are not traditional indexes.
Okay. Well, we do have a question from the audience, and let me just throw it out there for you guys. Is the argument one of passive versus active, or is it an argument of index versus other types of mutual funds? Or perhaps I am just misunderstanding the definition of passive investing. Are index funds the only form of passive investing? If so, then to me that would mean the argument for index funds is an argument of passive versus active management. That's the question. Anyone? Dan, Rick, you want to comment on that?
Yeah, so I think the question you're asking is, when you look at it from a broad base and, using the definition out there of benchmark cap-weighted indices, so I'm talking about, say, the S&P 500, very low cost, that is passive investing. You're investing in an index that's broad-based, market cap-weighted, and you're just going to do what the market does, and those are very low cost. Active management is taking your portfolio to a different level and deciding that, okay, there is the passive way approach to have broad market exposure. But either I believe, or my FA believes, or the client believes that I want to have exposure to a certain sector, or I don't want to be in a market cap weighted index, which I think has fundamental problems. And so you give your money to an active manager who focuses on either a sector specific or focuses on risk and rewards that are different than owning a broad-based index. And sometimes he's going to be right, as in a third of the time, and sometimes he's going to be wrong in 2/3 of the time. I think a lot of problems you have is you have closet indexers out there on the active management side. But I think the active management side, in the right hands of the right FA who understands his client's risks and needs is, just as good as a passive approach. There are some people that don't want to think about it and just want to be passive, and that's great and that's wonderful. But I think there's a lot of people out there that have their own opinions on things, and they see things from a different perspective, and they want to take a risk on that, and that's where I think the active manager, if sourced right from the FA, can add value to a client's portfolio.
Okay, Rick, do you have any comments on that, or do you want me to move on?
No, it's a good question because they're saying they're looking at the philosophy of passive versus active, and then the strategy, meaning how are you going to do passive. You can do it with index funds. So really, it's two different things. There's the philosophy of investing, which is passive versus active, and then there's the products or the strategies of how are you going to do that. So I could make the argument that it's passive. I'm a passive investor, but I do a 1 to 10 year treasury bond ladder of equal weighted treasury bonds. That's passive because I'm not making a judgment on whether interest rates are going to go up or down. When interest rates, every time a treasury bond comes due, I'm just going to roll it out and buy another 10-year treasury bond. So that's passive. It's a passive structure because I'm not making a bet, or I don't have an opinion about whether markets are going to go up and down, and I'm not adjusting my portfolio, or I don't have an opinion as to whether the market, in one segment of the market, whether you can outperform or underperform, whether it's more efficient or less efficient. All I'm saying is passive versus active is a state of mind. It's a philosophy, and then how you implement that can be done in different ways, through index funds, through a bond ladder. This is if you're a passive person. And they are two different subjects. They are two different things.
Okay. Next question comes in is, why is the index fund, or I guess we could rephrase that as, why is passive investing the best idea right now when stocks are at an all-time high?
Good. I'm glad stocks are at an all-time high, and I'm very sure that over the next 10 years they're going to go higher, and then go higher still. I can't remember a time in my life where stocks have not hit an all-time high. Have you? No, I don't think so. Maybe, not in this country anyway. So, I mean, I'm not a market timer. I'm looking at asset allocation for my clients. So part of their asset allocation said they should be in equity, and is they're going to get a portion of that is going to go to equity. You know, whether the market is high or not, I'm not basing that on a decision for if a client needs to have equity exposure. I'm not basing my decision on whether to go into the market or not into the market based on my opinion about whether the market is high or not, and using the fact that the market's at an all-time high. I mean, gosh, if you did that, you'd never be in the market, ever, because it's always at an all-time high. You know, it's very difficult to try to time the market, and we want it to go up.
Right. Next question that comes in. When people say you should take on more risk while you're young because you have more time to recoup, are they referring to your asset allocation mix, or are they referring to both your asset allocation mix and the mix of subclasses within the classes?
This is Dan. I'll start. Yes, I think they are talking about their asset allocation. You can look at the traditional 60-40 model. There's a lot of funds out there now, target date funds, that move the mix of bonds and equities as you get older to preserve capital. I believe that, yes, as a general rule, people that are younger should be willing to take more equity market risk than, say, fixed income risk. And I do believe it is beneficial to have allocation to sectors that are underrepresented in most of the benchmark cap-weighted indices. And then you can start to change that as time goes on.
Rick, care to comment?
No, I think that people, when they say young people should take more risk because they have time to make it up, are talking about equities in general. I don't know if that's necessarily true, by the way, that you should take more risk. I mean, theoretically, from a mathematical picture, yes, it's true, has been true, that you have more time to make up if the market happens to go down. And so from a mathematical standpoint, it's true. However, I think what we learned from 2008 is that, you know, young people can get scared out of the market just like older people can. And is it wise when you're just starting to invest whether you should do that, should have a lot of money in equities right off the bat? And that's a question for each individual investor to decide. I think that if you get scared out of the market because you happen to have invested in 2007 for the first time, and you lost 50% of your value, and you jumped out of the market, and you stayed out, and you're still out, I don't think that being very aggressive back in 2007 was the right thing for you. So there really is there's an emotional side to this as well as a mathematical side. Mathematically, it's correct. Emotionally, it may not be correct. And I think that each investor has to decide for themselves what amount of stock they should have when they're young. It really takes some getting used to. I know that when I first invested in the market when I was 22 years old, I lost 10% and I jumped right out. You know, I wouldn't do that now, but I did it when I was 22. So, you know, I don't have as much time now as I used to have when I was 22, but I don't have the emotional stability. I have more emotional stability now than I did when I was 22. So it's a mix of both.
Okay, you know, there was an article earlier this week on Fundfire, and it was titled "Consultants Retain Grip on Active-Passive Debate." And the article basically went through the fact that obviously passive investing is gaining ground with the consultant community, mainly in some of the retirement systems. They talk about how U.S. equity exposure at the end of 2007 was $933 billion in these systems, and it's now $2.5 trillion as of the end of 2014, where with active managers that number went from $3.5 trillion to $3.75 trillion. Both still positive, but obviously a lot of gains made on the passive side. But further in the article, I'm going to read a statement that's made, and I would like for both of you to comment on it. It says, the most prominent consistency among consultants is their treatment of the U.S. large cap equity and U.S. small cap equity strategies. The former, being large cap, is almost universally shunted into the passive bucket, while the latter has consultants backing an active approach. Makes sense, Rick? I mean, I'm going to let you go first, but does it make sense from what you talked about earlier that large cap, basically you can't pull any alpha out of the market, but yet there's still a lot of alpha assumed to be alpha by the consultants in the market today.
Yeah, I never said that you can't outperform the market. I said there's a low probability you're going to outperform, and when you do, most managers don't outperform by very much. It's also extremely difficult to look ex ante at who is going to outperform, and then they actually do it ex post. So it's it's an extremely difficult, complex problem to try to figure out when, in fact, you could just default to passive investing and be in the the 80th percentile. So from a mathematical standpoint, it doesn't make much sense to do active investing, not only in large cap, it's the exact same thing in small cap. The numbers are the same. And there's periods of time when more active managers outperform in a certain style, but it doesn't last. It's not persistent. By the way, it tends to happen when large cap significantly underperforms small cap. That's when large cap managers tend to outperform the large cap indexes. So why is that? It's because the indexes are very pure and the managers are very messy. They're not doing what's solely in that large cap box. They spread to mid cap and down into small cap. And so when mid cap and small cap tend to outperform by a great deal, since active managers are not really cap weighting, they more look like equal weighting, or at least they're increasing their bets on what they think is the best thing to be in. When but their portfolio is enough so that it's in the large cap Morningstar style box. So they're being measured against the large cap indexes when in fact their portfolios are not all large cap, so they benefit from the bleeding effect of their portfolios. Now it goes the other way. When large cap stocks significantly outperform small cap stocks, large cap active managers terribly underperform the market because they bled into mid cap and small cap, which are underperforming. Same thing with small cap managers. Small cap managers outperform when small cap stocks don't do well relative to large cap stocks. That's because the managers' portfolios are very messy. It looks like a shotgun blast across the Morningstar style boxes where they congregate into the small cap sector, and they're called small cap managers, but they have mid caps and maybe even some large cap stocks in there. So when small cap stocks underperform by a significant amount, small cap managers outperform. So you go through this period where large cap outperforms and small cap active managers look brilliant, and then small cap outperforms and large cap active managers look smart. But in fact, it's just it's a falsehood. It's a fallacy. In the long term, all styles, all strategies, the managers underperform over the long term. I may have strayed off the question, but that's the answer.
No, I think you were right on your point. Absolutely. Dan?
Yeah, so I think, when I look at it is, when you're an active manager, you have to focus on risk on, risk off trades, okay? And, an index cannot do that. And so there's a lot of things that are very dynamic in the market that active managers has to keep focused on. And so when you're talking about the large cap guys underperforming when the small caps, that is similar to a risk on, risk off trade. And over the longer term, again, it's almost as if you've got asset allocation. When you talk about what the consultants are saying, there's a reason that they're moving towards the passive management on a large cap, because that's not where value is created, because the information that you can get on a McDonald's is not very well versus the information that you can get by going out and visiting these companies that don't have any research coverage, okay, or no one calls into their earnings call. No one covers them. There's a lot of industrial and manufacturing companies that just don't have research coverage and don't have exposure, yet their businesses are doing tremendous. And that's why I think if you're an active manager and you're focused on core fundamental research, getting out there in the field and doing due diligence, you can uncover opportunities for alpha. And that's really the reason that I think you see the consultants moving the way they are is, yes, okay, let's just have this amount allocated to broad market benchmark. I'll go with the cheapest alternative, yet I want exposure to energy. I want exposure to MLPs. I want exposure to industrials and manufacturing. let me find a manager that can provide alpha because this is an underserved market and it's underweighted in the indices. And I think that's increasingly seen. You can look at the S&P 1500 of the industrial companies that derive the majority of their revenues from the U.S. versus those that derive the majority of the revenues from outside the U.S. And the ones that are here domestically are having a much better operational performance, and it's showing in their earnings. And the only way you're going to get allocation to those or see that and know that is if you've got an active manager.
Okay, I'll just remind the audience, if you want to send in a question, please do so over the next couple minutes. Rick, I'm going to go back to you here for a minute, and this goes back to a comment you made earlier. Obviously, with the ETF space, it sort of muddied the water as to what's index investing, what's passive investing, versus sort of active in a sense, and how an ETF is put together. How does an investor, a retail investor, cut through all that? I mean, it seems like they may have the same problem identifying the proper indexes that they may have identifying the proper active managers.
Sure. So let's say you're going to start out with your core portfolio of just U.S. equities, international equities, and a bond allocation. And you start out with your total U.S. stock market index fund, and there are several out there. Vanguard has one, State Street has one, iShares has one. The largest is the Vanguard Total Stock Market Index Fund, and it's extremely low cost. It's only like 5 basis points management fee. It basically gives you beta exposure to the U.S. equity market, the whole market, the entire thing, large cap, small cap, mid cap, and you get it all, and you get it cap weighted, and you get it very low cost with low turnover. And then you have an allocation to international stocks as well. And again, you use an international stock index fund. Again, getting back to Vanguard, I mean, they were the leaders in this space, so it's not surprising that I'll refer back to them. And I'm not an employee of Vanguard, but I do use several of their funds. The Vanguard Total International Stock Index Fund has thousands of international stocks in it, so both developed market and emerging market, and you're getting a cap-weighted allocation to the rest of the world with I think it's 12 basis points management fee. And so there you've got your stock allocation to the U.S., stock allocation to international, some mix between the two depending on what you believe, probably between 30% and 50% works out well. And then you need a bond allocation, and here it could differ. You could do a CV bond ladder, you could do a municipal bond fund, you could do a corporate bond index fund, you could do a total bond market, investment grade bond market fund, or you could do a mix of a few different funds depending. But so that's it. That's your core allocation, and I would venture to guess that simple portfolio has probably outperformed, let's say, 95% of all portfolios that investors and advisors have put together over the past 20 years. Because of fees, because the fees are so low. And really, when you get down to this index funds versus active funds, it's really a fee game is what it is. It's not anything more than that. It's just all about the difference in fees. So Matt, again, I don't know if I answered your question directly, but that's where I begin.
No, absolutely. And so, Dan, how do you take that portfolio that Rick puts together and give a client access to maybe something that they think is going to be more tactical and for a piece of it? I mean, that's his core portfolio, but how do you sort of bend the portfolio to give you some tactical plays for investors? Because we all know a lot of people don't set it and forget it for the most part. How do you?
I think here's the first thing is, a client has to really know what his interests and his needs are. And, everybody that has these allocation models of where I've got to have this percent bonds, this percent international equities, maybe they should sit with their client and say, maybe I don't want any exposure internationally. I don't want any dollar risk, et cetera. And so I think more importantly, does somebody need to have an allocation to a broad market indice? Yes. Is passive probably the best approach? Yes. The other aspect is sector rotation and allocation. That is where I think most people fail to realize what's critical is, reallocating your portfolio, resizing it, and with your FA or with your own analysis, making decisions on when you think you ought to allocate to a more sector-specific fund. And I do believe that sector-specific funds can create alpha because they're smaller, nimbler, and they don't have a lot of indices that medically represent the opportunities there. I mean, and that's a critical reason I think that it's sector rotation and allocation percentages outside of the traditional model that will really help add returns over the long term.
Okay, we had another question come in, and it's a good question. Is it possible to invest only in index funds and expose yourself to more risk? Or I guess maybe another way, is it possible to be a passive investor and really give yourself more risk or put yourself in harm's way? Maybe it comes at the point where you're resetting your portfolio maybe back to a 60-40 mix where you're selling your winners and buying more losers. Anyone care to comment on that?
Well, I guess the question is, if maybe you can clarify, Ken, is more risk than what?
Well, I guess more risk than the normal market. I mean, it doesn't say in what the listener was getting them to, but maybe take it in terms of resetting that 60-40 mix that we've been talking about through this whole call, where maybe your 60% bucket has moved up to 65 because of performance, and it's time to reset your portfolio. And say in this instance right now where you have an equity market that's doing really, really well and a bond market that's done well, but the equities have outperformed, now you're going to put yourself, you're going to take 5% off your equity portfolio and put it back in your bond portfolio, knowing that you may have some turbulence coming in the bond market down the road.
Well, sure. I mean, I guess my answer is if I knew that the bond market was going to sell off, if I knew that, and I'm not saying I'm going to speculate on that because that's what everything we have today is speculation. I actually literally had a crystal ball and I knew the bond market was going to sell off. Well, the answer is sure. I wouldn't reallocate at that time, but I don't know. I mean, the process of rebalancing means you're selling something that went up and you're buying something that didn't go up as much or perhaps went down. And so what you bought could, reallocating out of something that went up, that thing that you reallocated out of stocks, let's say, could continue to go up. And the thing that you bought more of, bonds, because interest rates went up and bonds went down, could continue to go down. So there's no doubt that you could be rebalancing into harm's way, but there's no way of knowing that today. You can't know that today, whether you're rebalancing into harm's way or not. I mean, it could be that as soon as you did the rebalancing, stocks started going down and bonds started going up. So how do we know? I mean, we don't know. What we do know is by doing a rebalancing consistently, religiously over the years, that it does, for the portfolio, it does tend to isolate the risk of the portfolio. And it tends to put it into a compartment, if you will, or put parameters on risk. If you're going to do a 50-50 portfolio or between 30% stocks and 60% stocks roughly, the standard deviation of those portfolios, if you look at any decade, tend to be pretty close, even though the return of the portfolio each decade is different. The standard deviation of the portfolio tends to be controlled, if you will, or within a certain parameter. So if you're trying to control risk, especially for retirees who need to live off an income, and you're trying to control risk, you can do it through an asset allocation. At least that's the idea of doing rebalancing. But again, you can't tell whether you're going to be rebalancing into harm's way or not. I don't know how you could do that.
Yeah, this is Dan. I think this is, if you're going to have a plan and an investment strategy, especially around sector rotation and allocation, you have to be very vigilant and very disciplined when you have those times that you rebalance. because we've thought that, there's a bond bubble for the past 2 to 3 years, and, everybody's like, when should I sell my bonds? And what I know is there are very few, if anybody out there, that can pick a top or a bottom. And so if you have a disciplined approach over the long term, I think that will help provide you superior returns, whether you're active or passive. A disciplined approach to portfolio sizing and allocation, I think, is very critical.
Okay. We have another question that just came in, gentlemen, and I think it goes back to Rick, something you commented on earlier. It says, I use Vanguard as my base index funds for equities. Where is the best place to put my bond money, in total bond fund or several other bond funds in the market? I am retired and 68 years old. Hello?
Yeah, I'm one of those guys who just hit the mute button.
So I thought I maybe had you stumped or something there for a minute.
No. So I was giving a great answer, but okay. So first off, I don't know any more about the person who's asking the question.
Absolutely.
So
it's hard to give individual investment advice, but sort of in a very macro way.
Yeah, exactly. I mean, the total bond market is a good place to start, but there's certainly reasons to diversify that more, or perhaps not even invest in that. You could split your portfolio up between corporate bonds and treasury bonds, treasury inflation-protected securities, or maybe if you're in a high tax bracket, you would use municipal bonds like the Vanguard Intermediate Term Municipal Bond Fund, which, by the way, is not an index fund, but it's more like an index fund than any municipal bond index funds out there, because it has more diversification and lower cost than any of the municipal bond index funds. So, people ask me, do you use only index funds? The answer is no. And they say, oh, wow, really? And I say, no, I use a Vanguard Municipal Bond Fund. It's not an index fund. But it's more of an index fund than any municipal bond index fund on the market. So anyway, so that's the answer. It's hard to give individual advice without knowing the situation. You could do it either way. I know people are using CD bond ladders instead of using bond funds. But if you're just doing an intermediate term bond fund, index fund of some sort, you're probably okay, as long as it's diversified and low cost. I don't think it matters all that much whether you're using a total bond market fund or a combination of a treasury bond index fund and a corporate bond index fund, and perhaps a mortgage fund in there as well. That's it.
Great. Thanks. Gentlemen, any closing comments you wish to make before we wrap the call up?
Closing comments. Sure, I'll start. And that is that, I came to this is Rick Ferry, I came to the conclusion that as an investment advisor, it is my responsibility, my fiduciary responsibility, to put together portfolios that have the highest probability for the client to meet their investment objectives. And because of that mandate that I put myself under, the fiduciary responsibility that I have, it has led me to this belief that index investing, low-cost passive strategies, not trying to time the market, trying to keep costs as low as possible, trying to stay diversified, trying to create an asset allocation for the long term for each client, has the highest probability to get my clients to where they need to go. I'm only paid from my clients. I'm not paid by the products that I sell. So I have this fiduciary responsibility to do what I believe is in my client's best interest, and that's where I have come to believe in this passive asset allocation and passive security selection strategy. So I'll end with that.
Dan?
This is Dan. Yes, thank you. As I said earlier in my opening comments, I think that there are roles for both passive and active investment options in someone's portfolio. I think that for those people that are seeking specific sector exposure, that active management in the long run should prove superior because of the fundamental analysis that most active managers do, and I think that they can help provide alpha I think critically for someone looking longer term is to sit down with their FA and develop a long-term strategy and just be vigilant and disciplined about that strategy.
With that, we'd like to thank everybody for tuning in this afternoon. I'd like to thank both Rick and Dan for their comments. For more information, if you want to check out upcoming events, you can go to the cefnetwork.com to see both the bios of Dan and Rick, as well as any upcoming events being put on by Pristine Advisors. Thank you, everybody, and have a great afternoon.
Thank you.